Hi, and welcome back to another episode of The Mortgage Musketeer, where today I'm going to be talking about how to create cash flow by leveraging the equity that is in your home, and I'm also going to be telling you why you should not pay your home off early. Okay, first and foremost, I want to talk about America's rising debt and how we're going to get out of it. And part of that is the rising equity that people have gained over the past couple of years. It has skyrocketed with housing that's been increasing anywhere from 10 to 20 something percent depending on where you actually live. So everybody's been talking about how it's created a kind of feeding frenzy in the market. But what we really want to talk about is, as rates are beginning to increase, what are we going to do with the newfound equity that is in the home? And we're going to be able to leverage that equity in order to reduce America's debt. Some important stats to know is that in 2021, in the third quarter, it was reported that household debt increased by $286 billion. And you can break that down into auto loans by $28 billion and student loans by $14 billion. Credit card balances alone increased in the third quarter of 2021 by $17 billion. So, what are we going to do? Well, it just so happens that the equity in our homes is an amazing tool to cancel out debt. So what I want to do is kind of take you through what does it look like if we leverage the equity in the home and pay it off. And I'm going to show you why you shouldn't be paying your debt, paying down your home loan, early, because there's a better way to leverage your money. Let's take a look at the computer. All right, so what I've done is I've created an analysis here showing you an FHA loan. Now this FHA loan, I use this because there's a lot of people in America that have FHA loans, and they're a good product. Oftentimes we'll refinance it out of an FHA loan into a conventional, but with the equity that's out there, depending on somebody's qualification, an FHA to an FHA cash out refinance can actually be powerful. All right, so in this scenario, we have a client whose monthly payments are $1,553 and their loan balance is $193. We're going to pull out about $30,000 out of this. We're going to drop the interest rate down to a 3%, and we're still going to lower the payment by like $29. And then we're going to, in this scenario, we're going to pay off around $30,000 of student, not of student loans, but $30,000 worth of credit card debt. That amounts to $953 a month. So if we take that $950, after we take the cash out of this home, out of the equity, we still have a lower payment than they already have. And then we're going to pay off those credit card debts, and we're going to free up a cash flow of $953. What do we do with that $953? Well, if we take that money and we invest it at a conservative 6%, we're going to be able to show net worth after 20 years. Now this is showing monthly savings is showing down $919. So you take $950, subtract the $29.77, that's what you get here. But what that is going to do is you're already paying that a month. We're going to take that and we're going to invest it at a conservative 6% a month, and we're going to show you what your net worth is going to be. The other option is if we actually just pay down the principal. We take the same amount and pay it down towards the principal. Yeah, you can pay off your home in 12 years. That is an option. However, it's not necessarily the smartest option. So let's take a look at the actual numbers over here. So this is just representing, the additional money put down. You're paying down either towards principal or investing it. $950 a month versus the $29 savings a month. That's all that's doing. And then this shows you over 180 months, so 15 years. So just by doing the cash out refinance alone, you're saving $65.33 a month. If you paid off the principal, yes, over 15 years, you would save 58 grand, almost $59,000 in interest. However, your net worth is not the same. And the reason for that is because when you put your money into your equity, you have to understand that equity is illiquid. In other words, you can't just pull out your equity, right? So you have to actually do some type of transaction like a cash out refinance or sell your home in order to realize the money that is in your equity. What we need to do is look at your home instead of a debt, a loan. It straddles both sides of the balance sheet. It is also an investment vehicle. So if we look at your home at appreciating at a minimum of a 4% a year, okay, and like where I live in Louisville, it's around 12%. In other places, it's as much as 20%. If we look at your home as an investment vehicle that is appreciating on its own, no matter how much equity you have in, whether you have the whole thing paid off or if you have a very large loan on it, your home is going to appreciate at the same rate no matter what. So look at your home as an investment vehicle that will appreciate, and with low interest rates at like 3%, you can invest your money, invest the cash flow that we saved by taking and paying off your credit card debt or other debt, and reinvest it. Reinvest it in your future. Get with a financial advisor. You can invest at even say a conservative 6%. Many people are earning 8 to 12%, okay, or more. The S&P 500 went over 22% this year, and historically is at a minimum of like 9%. So if we're saying you're just investing that money at a conservative 6%, your net worth over 15 years would be $668,285, because your home is appreciating at least a 4%, and then you've invested this money. Okay, this is liquid money that you could tap into at any point in time, and you are investing in your future. If you did the same exact thing and paid off your principal, your total net worth is only $534. That's over $100,000. It's like a $130,000 difference between these two. Paying off your principal is only going to save you $59,000 a month in interest rate. You are shorting yourself thousands and thousands of dollars by not investing in your future. And this is why the advice of, hey, pay your mortgage off, right away, add another payment, or whatever the case may be, doesn't necessarily add up. It's not necessarily the best financial strategy for you. The best financial strategy may actually be investing in your future and letting that compound, and if you do this if you did the same strategy that I just explained to you, and you let it compound over 30 years of the mortgage, you're going to have like $1.9 million in the bank or in your investments. Okay, compounding interest. Time is your best friend in the investment, and this is why we really need to partner with our financial advisors and then let them help you grow your wealth. The key here is understanding that our equity is an amazing vehicle to our financial future. All right, I hope this helped kind of educate you a little bit better and see the difference in there. Reach out with any questions. If you're interested in doing some type of refinance, reach out to your loan officer. I'll tell you the states that I'm licensed in down below, and we can actually help get you out of debt before the rates rise too high. All right, if you have any questions, you just let me know. Leave them in the comments below. I'd be happy to help. And until next time, it's all for one and one for all.